Joining us now to talk more about the markets is Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. He oversees $54 billion. Mark, thanks for joining me and Dom here on In the Loop this morning. Good to have you. So tell me,
good to be here, Lisa.
Futures point to a rally, but we've certainly seen that turn around quite quickly once the opening bell actually sounds. What's your take on the day?
Well, I think, the seasonality, of course, is the overriding theme here into why so many are holding out for a Santa Claus rally, and us amongst everybody thinking the same. Obviously, at the end of the day, we've been held hostage, really, to the events coming out of Europe. So in the absence of any new news on that front, I think directionally equity prices want to move higher. But I think today we'll be setting up for some of that on probably light volume as many start to depart for the holiday vacation plans.
Now, Mark, one of the things that we talk about with regard to these light volume days is this idea that if things do turn around, they can quickly because of that light volume. As you approach the latter part of this month into 2012, are there sectors you think are going to outperform all of the other ones?
Well, a couple we like, certainly on valuation, let alone the prospects of growth. One being technology, which on a valuation basis, when compared to its 15-year trailing average, is about 1/2 of what you would normally expect the multiple to be across the sector. And it's the one bright spot in terms of GDP activity in this country is business spending. So we look at that space to continue to do well and attract interest. Another being healthcare, also very inexpensive on a valuation basis, come under a lot of scrutiny, obviously, with pending healthcare reform. Nonetheless, demographically, a very strong theme, and you can look for yield in big pharma and or cheap valuations and the prospect for some top-line growth coming out of medical equipment companies.
And Mark, what do you make on the fixed income side as we look at credit markets? I know you were on Street Smart not that long ago, back in October. You liked high yield at the time. Has that changed at all?
No, not at all. We've seen some compression in spreads over government securities, but not much. It still looks exceedingly attractive to us. The opposite, of course, end of the spectrum is how unattractive government bonds look to us with nearly invisible yields. But we think if our base case holds, which is to say that we avert a recession in the United States in 2012, and even if we do sort of muddle along, in that context, clipping a coupon of 7 or 8% might be the kind of return prospects you might even expect to get out of the equity side of the aisle with perhaps less volatility in high yield.
We've had a spate of stronger than expected data, Mark, out of the U.S. Is there a real risk to the downside, though, if the next couple weeks of data come in exceptionally weak?
Well, certainly the U.S. equity market has taken on a defensive-like quality to it, and the markets have performed reasonably well vis-a-vis global bourses. I think you're right. Expectations have been building that we are the bright spot among other countries where, Europe is likely in recession. Certainly China and other emerging markets are cooling. So in the event we saw the recent pattern of sequential improvement economically start to deteriorate, pointing towards, once again, the threat of recession, then equity prices are due to, I think, a derating once again, and even a 12 multiple in 2012 forward-looking earnings that becomes vulnerable.
Mark, in this whole backdrop we've been talking about here, do you have some picks? What are the stocks you think individually will do the best in the coming year?
Well, a couple from the sectors that I just talked about, and the theme here being high quality, high dividend, is Microsoft, a stock that has, certainly not a lot of love given the fact that its share price hasn't done much over the last decade, but recently it's begun to perk up a little bit. High free cash flow yield, $50 billion in cash and north of a 3% dividend yield. Johnson & Johnson in the healthcare space, one of 4 AAA rated companies, Microsoft being another. Once again, a 3.5% dividend, high free cash flow, obviously quality balance sheet, globally geared to take advantage of growth coming from emerging markets, which even while slowing is still 2 to 3 times the pace of the U.S. Those are the kinds of characteristics of companies that we find appealing.
Mark, very quickly, we got 10 seconds here. You also like some of the financials. Why is that?
Yeah. Well, Lisa, this is a bombed-out sector, obviously, and we think valuations have been beaten down to the point where upside looks pretty appealing if only a couple of things start to get relieved on the regulatory front and business continues to improve.
All right. Thanks so much. We got to leave it there. Mark Luschini of Janney Montgomery Scott.